We're here today to talk about where record cash reserves could go after a pretty bumper year in 2020. According to the Bank of England, there is £215 billion held in savings accounts, paying zero rates of interest. And during 2020, many people became what we call accidental savers due to lockdowns, regional restrictions that limited their spending. As a result, there was 150 billion saved into cash savings accounts during last year. So by October 2020, savings balances had reached 111 billion compared to just 45 billion in October 2019. So that's quite a lot of growth. Now, I'm joined today by Rita Verma. She's a chartered financial planner at Wren Sterling to discuss what people could do with the cash they've saved to aid their long-term financial plans. So hi Rita, thanks for joining us.
Thanks, Nick.
Okay, great. Well, first of all, saving can be attributed to lifestyle restrictions, but also to this nervousness around future prospects. So if there's going to be an economic crunch point that results in higher unemployment, then it makes sense to save some extra cash to meet short-term expenses and for peace of mind. I think we're unfortunately starting to see unemployment figures creep up, so this has some validity. But Rita, if someone already has a pot of rainy day money, their employment prospects are good, or they've retired, what should they be thinking about doing with that money?
If you've accrued additional cash in the past few months as a result of COVID restrictions, now is a very good time to reassess your financial needs. Cash is an asset class in its own right. It's one of the four major asset classes, including fixed interest securities, properties, equities, and it's designed for short-term access. However, leaving excessive funds on deposit will inevitably lose its value, its real value through inflation over time. At present, the typical interest rate of an instant access account is approximately 0.1%, and it's not expected to rise anytime soon. So it means it's likely to remain below inflation. Thinking logically, before the pandemic, the markets were generally working fine. It's external events which causes chaos. Now, when the external event is taken out the equation through successful vaccination, etc., there will be high levels of liquidity in the market due to the unprecedented levels of the global fiscal stimulus, which will end up somewhere. And the likelihood is it'll end up in the stock market, resulting in positive growth in the markets.
Okay, so listening to that, if someone is looking to invest to target higher returns and capitalise on potential growth in the markets, what would you say to them?
Nick, it's very important to invest without fear and invest within your comfort risk level. It's also important to note every bull market, bull as in when the markets are rising, and bear markets when the market goes down. So every bull market turns into bear market, and every bear market turns into a bull market. So bulls and bears are part and parcel of life. It's wise to take advantage of the market when it's low, not when it's high. What normally happens is when the markets fall, people panic and pull out. And when it rises, people start investing, which is the complete opposite of what we'd expect them to be doing, which is where we as financial advisors walk the path with our clients, guiding them on the way. Yeah. Over a period of time, we would expect markets to have an upward bias. The markets are expected to continue to rise in the long run through drivers such as innovation, technology, growing populations, and the development of consumerism in developing nations. The biggest risk when investing is not market crashes or corrections, it's being out the market.
Yeah. And I think over the last 12 months, we've really seen the benefits of global diversification, haven't we?
Yes. Portfolio investment is globalized, so you take advantage of returns worldwide, not specific to a given country such as UK. Now, during this pandemic, UK equity markets have been hit due to the large heavy weightings in financial and oil markets, both of which, as you know, have been hit as a consequence of the COVID. However, if you take a look at the US markets, They've thrived due to the heavy weightings in technology and innovation stocks, such as Facebook, Apple, Alphabet, Netflix, Tesla, Microsoft. Now, this isn't about picking stocks, but an illustration that diversification is important, and portfolio approach will capture the star stocks of 2021.
Yeah. Okay, so given the potential ups and downs, what would you say to someone who was nervous about putting a lot of their money into investments at once?
If you want to take advantage of better return potentials, but you're reluctant to commit a large portion of your cash, I'd be wise to invest part as a lump sum and part on a regular basis. So as a lump sum, should the market rise, obviously your capital benefits, but where there's volatility, saving a small amount on a regular basis, you're catching the market at different points. So there'll be times where you catch a small amount at a certain level and the market's fall, you catch the market at a lower level, and over time you benefit from pound cost averaging. So effectively you get the best of both worlds. If you do decide to invest your spare cash, have conviction in your decision and block out the headlines. Markets are forward planning. It works at least 6 to 9 months ahead of time. So any information you receive, the chances are it's already been reflected in the market. So at this moment in time, vaccinations have been confirmed and rolled out. It's expected to be 90% effective. Brexit has been finalised. However, there may be short-term issues, such as vaccination not rolled out quickly or effectively, or unemployment levels rise after furlough schemes end, which could lead to lower consumer confidence. But when you invest, you should invest with the view of longer term, so 5 years or longer. Therefore, current volatility will form a smaller part of the overall period.
Okay, that all makes good sense to me. Rita, thank you for that insight and thanks for joining me today.
Thank you.
Remember, if you are looking to start investing or you want to add to your existing portfolio, you should get independent financial advice to make sure you're making the right decisions, and Wren Sterling can help you with that.